Let's talk mortgage. 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 What's going on, everybody? Zach Macmillan back with you. Let's talk mortgage. Here we are again. Got a quick tip for you today. You see I'm real casual. Got my liquid glasses on for you so you can see how I look with glasses on, because it's probably how you see me if I'm out and about, really. So quick tip for today. I'm talking about student loans. If you have them, a lot of us do. Right now, currently, if you're in 2023 or going through 2022, whenever you're watching this video, your student loan may currently be in forbearance or pause right now. Basically, don't have a student loan payment. And so you're thinking to yourself, perfect, it's a good time for me to buy a home. I don't have a student loan payment. They're not going to factor into my debt to income ratio. I'm good. And that's not correct. As you can imagine, your student loan payment isn't just for a year. It's not just for 2 years. Typically, you're paying for those for a number of years. A lot like your mortgage payment that lasts 15, 20, 30 years. You're paying for this mortgage for a number of years, and therefore it's very likely that your student loan payment isn't going to be forbeared or paused or suspended for 15, 20 to 30 years. So when that comes to the case of your student loan payment, when we calculate your debt to income ratios, we have to factor in your student loan payment, even if you're not paying for them right now. So please bear that in mind. Now, depending upon what program we use will determine what calculation we use for your student loan payment if there's no payment showing on your credit report. So for instance, there are some programs that require us to use 1% of the outstanding balance as a payment for you. So for quick math, because I told you all, we'll be doing math on this page. I don't care if you like it or not, it's part of the process. So let's use some simple numbers, easy to calculate, easy to follow along with. Let's say you have a student loan balance of $100,000. So under certain programs, I may have to use 1% of that outstanding $100,000 loan balance. So for instance, that 1% of $100,000 is $8,000. So therefore, if your payment is zero on your credit report and you don't have anything showing what your current payment is supposed to be, then we have to use $1,000 as a payment for your student loan balance. Yeah, that's a lot. Now, you probably aren't paying $1,000, but because your credit report says zero, I can't leave that number at zero when calculating your debt to income payment. So I have to use that $1,000 unless we can show something showing what your student loan payment is supposed to be. So remember, I said this is a quick tip episode. So here's a quick little tip. Your student loan servicer should have an option for you when it comes to student loans that's called income driven repayment, IDR. Most programs will acknowledge the income driven repayment program to allow us to substitute that payment with what is on your credit report if there is none showing. Also, if you have a student loan payment and you feel like it's too high, you can apply for the income driven repayment program, and they will calculate a monthly student loan payment for you that is calculated based upon your current income. So you may or may not have to submit your paycheck stubs. You may have to supply some information to them, let them know what you're making so they can factor in a student loan payment that is conducive to your income. So you aren't having to pay $1,000 a month in student loans and you only make $1,000 a month. That just doesn't quite add up. So with that being said, the income driven repayment program that you may be on, when it comes to calculating your debt to income ratios, I can use that payment given to you by your servicer to calculate a substitute of that zero payment that's showing on your credit report currently. This is a big deal because of the fact that we're going back to that $100,000 that we have on your credit report balance for your student loans, where I may have to put a $1,000 payment for you because it's showing zero, or a $500 payment because it's showing zero. When you get on that income driven repayment program, they may give you a payment of $250 a month, $200 a month, $300 a month. Either way it goes, these numbers are a lot less than $1,000 and $500, which is going to cut into your debt to income, which is also going to cut into how much home you'll be able to afford because it's eating up all your income essentially. So, quick little tip for the day. I hope this was useful. Take a look into it, see if it's going to help you out, see if it's going to help you be able to purchase that home that you were looking for. I'll see y'all back again for Let's Talk Mortgage.